Now, at what point do you decide to, okay, now I've done investment. At what point do I hold or do I buy more or I sell the assets? This is something that most Forex traders always face. When finally you've done an investment, you've actually made a position in a currency pair that you've done a critical analysis of everything has gone your way, or you're like, oh, should I hold or should I buy more? We always normally see this when people are trading USD pairs during non-farm payroll. I'm sure Osajifo and his people will tell you much more about the excitement of the volatility when it happens on the first Friday of every month when you're trading USD pairs. People are just looking out for what the figures are going to be for non-farm payroll. Now, at that point, you're going to ask, should I buy more or should I hold, or what should inform your decision? Now, first of all, if it's I'll put this in perspective of equities, then later, then maybe related. It's much more relatable to Forex too as well, right? So first, you've done your investment analysis, you have your investment thesis, you've identified why you want to invest in this company. The fundamentals are strong. You know what the fundamentals are. Look, revenue is growing, cost is actually shrinking, or even if cost is growing, it's growing marginally. Their net profits is looking good. There are much more market opportunities for them, and you're based on this, you're like, this is the reason why I invested, and I'm seeing the same things. So fundamentally, everything is okay. So if I see some market volatilities, let's just say the macros, all of a sudden all of a sudden the currency is depreciating. Should that mean I should sell? No. If your fundamental thesis are still hold, then hold that particular security. You've not hit your take profit. You've not hit your take profit, so hence it's advisable for you to hold it. Now, these are reasons why you continue. I would want to hold a security because the fundamentals hasn't changed. Now, at what point do I buy more? What point do I buy more? Let's just say, like, let me relate it to Forex. You've bought your USD against your British pound. Your whole notion is US is going to be stronger than the British pound because of some fiscal issues that the British are currently facing. So you already know about their debt situation, how they don't have much more fiscal space, and what's happening in their whole budget constraint and all those things. So hence you think the USD is going to be stronger than the British pound, right? So fundamentally, this is what you've done your analysis based on that. You know what your catalysts are, and all of a sudden you see that my whole notion is the US is going to be stronger than the British pound. And all of a sudden, the British pound is gaining some strength. You would want to go and check what is causing that. After doing your analysis to see what is informing the market, you notice that it is just some hedge fund trying to play around, or someone just making a big position, or some the market, market makers try to fake out and take out your positions. There are some critical levels that they look, and all of a sudden there's a fake out, and then it just blows your position or hits your stop loss. So when you notice these things are temporal, then that's the point where it gives you the notion to buy more. These are things that we've seen happen. So for instance, we know of this big AI stock, right? Everyone talks about Nvidia. There was a point where in 2017 or so, Nvidia was trading as very low, and all of a sudden there was a 70% drawdown. 70% drawdown, it's a lot. Would you have the stomach for it? If you believe the fundamentals are strong, the main reason why you bought Nvidia around that time is because you foresee AI growth, you foresee that people are going to start moving towards AI and everything, and because of that, your fundamentals are still the same. Remember, this is before COVID and everything. So if you believe this is what you are and your thesis, nothing has changed. That 70% drawdown has given you opportunity to have even a good entry point, or even buy a good security at a discounted price. So hence you go in and you buy more. That is as long as it doesn't affect your portfolio construction. Because if your whole target of your whole portfolio is, I want to allocate maybe 5% into Nvidia, right? And I've done 4%. I've done 4% into Nvidia. I have 1% more that I can allocate to Nvidia. And now the drawdown has actually made Nvidia more cheaper. I can now buy more to make sure it's hit or rebalance it to almost 5% of my portfolio. That's something that you can do. So that's an opportunity for you to rebalance and buy more. So you can at least set your target allocation, right? And still have that belief or conviction that there's going to be growth. That's a opportunity or a buying opportunity. When you see securities that are of good value falling, that's when you buy more. Or what most traders will say is when the market is panicking, that is when you buy more. We saw that happen in 2008. When the market was panicking, you saw the king of investment, which is value investment, which is Warren Buffett, buying more of the securities. We saw he bought Goldman Sachs, he put money into Bank of America and all this. That was opportunity. So to him, it was a buying opportunity. We saw people like even Howard Marks of Oakfield, when we saw that people were panicking, people were selling their securities, that's when they were coming in and they were buying more. And they generated a whole lot of money. People like Apollo, KKR, these are big fund managers who came in when the market was panicking. In COVID, we saw that happen before the government came to step in. That was when people were buying more, right? Now, at what point do you sell? There are many reasons why you sell. When you think your valuations are being overstretched, that is when you see something close to what you call a bubble, where everyone is just buying, 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 buying. We saw that happen in 2021, 2022, when the US was literally giving money to people. People were just buying stocks. They were not working. They just wanted returns. So people were having free money. People were just putting money into risk assets. They were buying much more of cryptos. They were buying much more of stocks and everything. That's when everyone is just flooding the market with money, and it doesn't justify the valuations at which they are investing. At that point, valuations, we can say, has been overstretched. We've seen that happen in the dot-com bubble. I'm sure when you start reading financial news and financial journals, you'd get to appreciate what I'm talking about, right? That's when you see valuations are overstretched. And currently, it's been perceived that this AI is getting to a point where valuations of AI is getting overstretched, where I don't know if you've noticed Warren Buffett has been holding much more of cash. He hasn't he has a lot of money, like over 200 billion in cash. He's not investing. He has sold down some of his stocks and everything, which is making people think that he's perceiving that there is a bubble upcoming. That's why he's holding on to cash. He believes that valuations are stretched. You can see that for Tesla. We can see that for people are even saying that for even Nvidia, where the performance doesn't justify the price at which these stocks are trading, right? That's when you can see that. But for currencies too as well, there was a point where we said no, the dollar strength doesn't justify what's supposed to be, where the dollar had gained so much strength that it was affecting even the US citizens themselves. We saw that happen, I think, in 2023, thereabout. The dollar strength was very high. Yeah, I'm sure you know the index, the DXI index. You can use that to, it's an index that you can use to check the dollar strength as well. These are things that I'm sure when you go into your technical analysis, I'm sure they've taught you much more about them, right? So that maybe there are regulatory hurdles, things are happening. Maybe a regulator comes in and says, hey, antitrust, or you're a significant market power or something. These are things that could inform your decision to sell. Maybe liquidity constraint. You've invested your money and now things have happened and now you need money. You have no option than, you know what, you sell down some of your stake to crystallize some of your capital gains, to use your to at least have some money or have some liquidity on you. You could also reduce or sell some of your assets or even your positions, mainly because you want to reduce your exposure, because you're looking at the risk level. As I mentioned, I told you there are some points where, look, government of Ghana had become risky. So hence what you have to do is have to sell some of my stake, my government of Ghana bonds so that my portfolio is not too or highly exposed to a risky asset. So that's the reason why you may want to sell your securities or your positions in a particular asset class, right? The same, you could also what you also sell because maybe you hit your take profit level where I'm sure they've told you that you can't just assume that you just buy it and to just continue rising forever. There'll be a point where there'll be some swing, there'll be consolidation in the market, and probably you would have a attainable take profit. And I always say, look, you must have an objective. Whilst you've now decided that this is the currency pair I want to invest in, at what price am I entering? What's my entry level? What is my take profit one, take profit two, right? And then what is my stop loss? So you don't be greedy, because when you're greedy, obviously you all know what happens to greedy people. You surely lose all your money. Now, what are some of the things that traders who are trying to get into the fund management role, what are some of the things that they should focus on developing, right? I've given four, I think, are key success factors for you to move into a fund management role, right? You need to be passionate about finance. You just you you shouldn't see finance as a job per se. You need to be passionate. When people are talking about finance, when the Bloomberg is on, you want to listen to what they are talking about. It should come natural to you, right? You should always focus on self-development. You always want to know what's happening because finance is a fast-paced um, environment. Every single day, new information and new things happen, right? All of a sudden, there's AI. You need to learn more about AI. How do you make money off AI? All of a sudden, there's new technologies that's happening. ETFs. You're talking about traded funds. What's that? You always need to learn, and you have to be passionate about it. You don't just stand up and just be like, see it like a chore. It's not supposed to be so, right? You also need to build a track record. For someone to feel confident with you, they would want to know what you've done. Even just like how we always want to even move to someone, right? You always feel credible. You always want to move to someone who you feel is credible. And the way you can justify someone is credible if you know the track record of the person, you know that the person has done this, has done that, you feel comfortable getting closer to such person. The same way, right? People who want to move to fund management roles, right, should have a track record. There are many ways you can build a track record, right? For FX, for instance, you can be when you're trading on your demo, you need to be making journals, be recording what you're doing, what went wrong and everything. So you can have it when one day you can even share it with someone. We always do what we call back testing. You back test what trade ideas you want to do and how you've been able to perform during a particular period. You can use that as a marketing tool if you want to enter into fund management role, because people actually feel safer when they know someone has a good track record and build a system. You don't just stand up and just all of a sudden just enter into fund management. No one would give you your money just like that. You need to have a system, what works for you. And before you can actually build a system, you must have to try. And that's why I mentioned about back testing. You must know what works for you, how you can stick to it, and how that system that you've generated will help you to stay disciplined. Because if you don't have a system, you can never be disciplined. So it's always very important that you build a system that works for you. And you need to communicate, have communication skills. You can't look, you can have the best ideas, but if you don't know how to break it down for people to understand, no one is going to buy into your idea. So it's always important to build communication skills. And one thing you will notice about all these things I've mentioned, right? All these are not technical skills. Because I believe technical skills can be developed. You can learn on the job. You can learn technical skills on the job. Someone holds your hand and can teach you, hey, you do this, you do this, you do this. Your mentor can teach you what a good entry point is, how to do your stop loss. Your mentor can teach you all this, but your mentor can't teach you to be passionate. Your mentor can't teach you how to communicate effectively. These are things you need to develop on your own. Your mentor will not be able to hold your hands in to build a system directly. He can guide you on building a system, but it's all up to you. He can't teach you to be disciplined. It's all up to you. So that's where you have those are the skills I believe that you need to focus on and develop yourself. Then the rest can all come in. Okay. Um, what advice will I give upcoming traders and people who want to enter into the fund management role? And you're entering, first of all, you're entering in a point where there's a lot of uncertainty. Trump comes with volatility. You are entering in a point where, in theory, they tell us that when um, in theory, they tell us that when interest rates are rising, what happens to stock markets? People move to fixed income securities. Stock market doesn't get much attention. But unfortunately, that's not what's happening. Interest rate is going up, stock market is going up. You move to a point where what we've been taught in theory does not happen. It's not happening now at this point. So hence, there's a lot of volatility and there's a lot of uncertainty. And my simple advice is know what you are doing. Know what you are doing. Before you step in, before you commit your funds, before you commit your energy, know what you are doing. You don't just open a live account and just put in some $100, $500, $300, and you're just buying position with lot size 0.1, 0.2, 0.3. You must know what you are doing. Investment is not something you just come in and all of a sudden you have just you have a wild chase and I'm just putting in and I'm just going to drive a Corvette in the next 3 years. No, you need to know what you are doing. And the best thing you can do is also diversify your investments. Even on your personal level, if you are earning salary, you don't put all your money into one particular CIS or mutual fund or unit trust. Diversify just in case something happens. What I mentioned, have some sort of strategies to ensure that you can have some umbrella to hold you or cushion yourself when the losses come in, right? It's always important to also identify what the noises are, right? Identify the noises because look, you're in a point where there's information overload. There's information about this, about this, about this. You just need to know what point is the noise and what the main message is. It is a skill that you believe and that you can get. And what you can do that by building a system. When you do that, you'll be able to identify what the noises are and then ride the trend. I always say, look, it's a $1 trillion market, which is the Forex market. The movers and shakers are the government and the big banks. Your $100, $300, $400 is just speculations. It's not going to move the market. So always do not go against the trend. The best advice I'll give is ride with the trend. Do what the market shakers and movers are doing. Ride with the trend. And also do not hold on to your losers for long. You had your whole thesis and now things have changed and you are just saying, no, it will ride to your direction. No, you're going to be eaten by swaps by these Forex brokers and you're going to start losing money. So I would urge you to know when to cut your losses and just say, I got this wrong. Let me sit back. What changed? What happened? Because look, in Forex trading, you can't be 100% right. George Soros and these big Forex traders that we know or made money from Forex do not make 100% returns. They make some losses too as well, but they know when to cut onto the market. And when a volatile market, always have a long-term focus, right? In a volatile market, it can just go up and down, up and down, up and down. Don't be someone who just invests and just opens the 5 minutes chart and be looking at the volatilities in it. No, please have a long-term focus. In a volatile market, markets moves a lot. So do not open your 5 minutes chart, 15 minutes chart and be making an analysis of the no. Have a long-term focus. So that's what I would advise you in order to overcome these fears that you have, whether you lose all your money and everything. It's much more important. Just know what you're doing. And I will end with one rule of investing is always leave your emotions at the door and always diversify. This is something that I have learned in the hard way. And hence, I would always say, look, when you're investing, leave your emotions. Else you would invest and every 5 minutes you're looking, you're panicking. And whatever news you're just and when you are emotional, that's when you make much more losses. You just invested in 10 minutes, you are wiped out, then you're like, you're going again. Now you're sort of gambling. Those are the things that happen to gamblers. They're addicted. You've invested and you have you're just looking at the 5 minute chart because you've lost $20, $30, or $50, or you in your last position, you're entering. You sold and you sold and the market was a buy. Your stop loss has been hit. Immediately you're entering because you want to gain back your money. That is when you are actually emotional. And when you become greedy, your take profit is this. You've had imaginary take profit where if it hits 1.25000, I'll take profit. It has hit 1.2500 and you've left it, you're like, nah, it will go more, it's going more, it's going more. The more you're thinking, the more you become greedy, the more you very soon you just one news and all of a sudden you're wiped out. So it's I always say leave your emotions at the door when you're investing. Become like a robot when you're investing, generally. That's what I'll say. And always diversify. Don't put your eggs in one basket. One of the best books I read in Forex trading when I started was this book, Adventures of a Currency Trader by Rob Booker. It's an interesting. It's a fictional book. It's about Harry. Rob actually is very good in writing because he puts in a perspective which made me. This was one of the book that I read, and within 3 days I was done reading because I had too much suspense and I was so much interested to see what's going to happen. One of the books that talks about technical trading and it doesn't make you feel like you are learning. Like it puts the whole character Harry in a position where you want to see what's going to happen because Harry he used to work as a clerk in a law firm. Got to know about forex trading. There was a magical software or something. I put your money in, you get money. You put money into it, he lost everything. He made some money, then also lost everything. He started having some setbacks and things. His wife loaning him money, going back into learning from a mentor. Like it teaches everything about what retail traders go through. So it's a book that I would highly recommend. It's been sold. I can't share the book with you, but I mean, if you have my contact, you can hit me and maybe I can help assist you on where you can get the book. It's not for sale, actually. I'm not selling the book or something, but there's a book I'll highly recommend to you to read. I've read a lot of books, a lot of YouTube videos and things, but I'll highly recommend Adventures of a Currency Trader as a way or as a stepping stone to how what the forex traders go through on a daily basis and how you can actually become a good forex trader too. So I'll like to end my presentation here. And if you have any questions and anything that you want to say or comment, so that we can have a discussion. Let's make this interactive.
Wow. Thank you very much. Actually, you really dropped a lot of nuggets. Yeah, I myself have learned a lot, and with what you're saying, back testing, having a very good this one system to trade. That's what Eighth Wonder is about. Actually, we're a software um company, so we provide journaling software for these retail traders in order for them to automatically journal their trades and also build a verifiable track record that they can share even to their peers or to anyone who is interested in investing with them. You see, so when we came into the market, we realized that yes, like there is this get rich quick scheme, like the gamblers mindset among like most forex traders. So we decided to have this boot camp as an awareness. So if they themselves know, so from day one, we didn't focus mainly on forex trading. From day one, we did financial literacy and personal finance and like the need for them to build an emergency fund, diversify, and all of that. You see, and today having you on board, like you've really cemented who there's our mission and vision for this boot camp. Thank you very much, Emmanuel. You're muted.
I said you're welcome, Masaja, for and your
Yeah.
participants, and I'm always available for any interactions. I'm sure you can even share my LinkedIn with some of them.
Yeah. So, guys, the floor is open now. If you do have, yeah. So we had Senyon asking a lot of questions in the chat. So let me read some. So there's this one. Given what happened to pension bond holders, what should such people invest in at the moment?
Okay, so given to what happened to pension holder, which you remember I mentioned that majority of the funds that pension holders had were into government of Ghana securities, so hence they were affected by the domestic debt exchange. What that meant was they had they had bonds that were yielding over 20%, and then they were made to submit those bonds into to swap those bonds to a new bond that was yielding lesser, which is around 8.25%, right? So what we actually do at this point is we are letting pension holders to diversify their portfolio, try to reduce their exposure to government of Ghana securities, which includes T-bills. Currently, T-bills is hot cake, trading around 28, yielding around 28 to 30%. However, if you're a pension fund and you have 100 million, and out of the 100 billion, you've already been locked up with 70 million in government of Ghana, and you're still putting all the same thing into this. You're exposing yourself to more risk. So what we are doing is we are teaching them, or we are putting their funds into non-government or government of Ghana securities. This includes what we call repurchase agreement, which is you giving your money to a bank for a fixed deposit. However, it is backed by a collateral or a security. So if you notice, the market has moved, majority of funds are moving into repos. Also, there are some investment products that we give to these our pension guys where they're able to put their money into outside Ghana, which is so an example. Remember I mentioned about the Eurobond, where you allow you to buy securities in other jurisdictions. So they put their money to CISs, which gives them exposure to other currency, um, other countries. So through their bonds and other stuff. So there are many things that we are recommending to our pension holders. At this point, even some of them are even they are putting money into I don't know if you know of it, the new gold ETF, which is an ETF that tracks the gold. So some pension funds have put money into it, so they can have exposure into the rise of gold, right? Currently, there are some things that are happening in the markets that we are currently still in talks with the regulator about, because of the whole dollar thing. The regulator doesn't allow us to be purchasing much more of dollar assets, because that would mean there'll be more dollars leaving the country. Already that the government needs more dollars. So there are some temporal ban in investment into dollar denominated stuff. But there are ways around it that we are doing. So there are many things that we are doing for our pension holders, apart from just increasing their exposure to government. Even though we believe that there are some changes, that we are in what we call a fiscal recovery phase. Things are improving. After restructuring, the government have had some leeway. We are under an IMF program. We don't see any government default, any happening, all things being equal. We've seen some credit upgrades and things. There are a lot of things that's happening that I don't want to bore senior and your people with much more technical jargons of what's happening.
Yeah, that's very true. And you see, there's this thing that I've realized among, let me say, other institutions that what Sentinel is playing in. So I've realized this company is it IC Markets. yeah, IC Markets and Black Star Advisors. So these guys, I don't know, they've come up with packages which is more tailored towards let me say retailers. You get it? So let me say Black Star Advisors, for instance, are giving this one investment packages to, let me say, the youth, they like the yeah, more of the youth through is it Achieve, the Achieve app. And we also have IC Markets coming up with their own platform. So since you are on here representing Sentinel, do you guys have like a package like that for budding youths who would like to diversify into institutions like you?
So yes, that's true. We have some products that have been on the market that's tailored to retail. So Sentinel, we have three products. Our company has three products. We have the Sentinel Ghana Fixed Income, which I manage, right? So we are investing. This is just mainly you putting money into denominated fixed income securities, right? So it's tailored to retail folks. With a minimum of 100 Ghana cedis, you can invest. However, because we've not had a lot of online presence and things, because you are trying to have our systems in check before we start appealing to retail folks. So you'll notice that that's why you don't hear much of our products. That's one. Number two, Sentinel, we have the Sentinel Africa Eurobond Trust. So that I think that's one that's very known by institutional investors and not retail. It's known by retail, but people don't know. So I'll let people know today. So if you look on the Achieve
Okay.
app, there is a Eurobond product. That Eurobond product you see is being managed by Sentinel Asset Management. So if you look on the
Oh, okay.
Achieve, there are three products. There are DigiSafe, which is managed by Blackstar. Then there is a Global Tech, which is managed by Blackstar. Then the last one is the Eurobond. The Eurobond is being managed by Sentinel. We are the fund managers of it. So we are on
Oh,
the Achieve platform that you mentioned about, right? So the Eurobond generally is you give us the money. You know, you're not the only person. There are institutions and pension funds who have brought money to as well. Then we buy Eurobonds issued by African countries. So in our exposure, we have Nigeria, South Africa, Angola. We have Cameroon, we have exposures in many countries, and all of these are dollar denominated. Even Ivory Coast is in euros. So you see that your money, you see that you're giving us, we invested into dollar denominated, dollar and euro denominated assets. When the returns come, we then distribute it, and you see the growth in it. So you'll notice that even when the currency depreciates more, your income goes high. But likewise, too, when the currency appreciates, you see an effect on your investment. So we have that product that is on the market, but it's through the Achieve platform. We are yet building our systems to be able to accommodate retail folks. So we are now having a revamp on our website to have to give
okay.
investors the opportunity to sign in and sign up to our products and have direct access to us and not through platforms like the market platforms like what we've seen. So we wanted to do a test, a beta phase of that. Then later we come up with our own app too as well. Then we'll start with our brand awareness. Currently we are just trying to build up before we start hitting because retailers can make you and retailers can also bring you down.
How? How can retailers this and bring you down?
Oh yeah, retailers can break you down mainly because let's just say someone has invested 100 Ghana cedis and for some reason he's trying to withdraw and he's having technical issues. He hasn't contacted you or called you for why he's having issues. All of a sudden, he goes to Twitter and just say, this company is a scam. I've been trying to withdraw money. It's not being able to withdraw. And everything. Meanwhile, it's not mainly because of that. Probably there are some technical issues. Maybe you didn't fill the form well or anything. That has caused your inability to receive your funds. But a retailer just goes on social media, just says this, and then you will not have your chance to even say it, to explain yourself. I'm saying that retailers can make you and can break you. We saw what happened during the mark to market because they were not fine. There wasn't much market literacy on them. What people were doing was they just go online. Hey, I can't withdraw my money off EDC. EDC is going down. Data bank, blah blah. You see, people are just retailers are just commenting and things, and people just rush. They're trying to withdraw. When everyone's trying to withdraw, remember what I told you, liquidity constraints. So now the fund manager will have to sell assets that are yielding profits or something to be able to pay you off. And in doing that, it affects those who are still in the fund because that gain they would have enjoyed everything, but now that gain is being slashed just to pay off someone. So with that, I'm saying retailers can make you and they can break you. We've seen that happening several times, even on banks too as well. If you look at what happened to Silicon Valley Bank, I'm sure you guys read a lot. What happened to Silicon Valley in the US, where there was a run on the bank and all of a sudden, boom, it just happened. So it's Ghana too, it has happened. GN Bank, it happened when there was a run on the bank, everyone just gets going and that's it. The bank had to collapse. So there are many reasons. As you have to, when you're entering into the retail phase, you have to one, get your market right, your product right, your technologies right before you start marketing more to the retail.
Oh, okay. Yeah, that's really true because I personally, I mean, is it Plus Invest? I don't know who manages those funds, but then the platform's name is Plus Invest, and yeah, and one way they went about this whole thing was they created a community. So it's like immediately you download the app, you automatically get a link to join their WhatsApp community. And if you should look at their community, bro, they are not discussing investments. Even every day we have people complaining about they not being unable to withdraw funds and stuff like that. You get it? So always what I tell myself is okay. So meaning if these guys didn't have a community, then what you are saying, that's exactly what they'll be doing. They'll be online just spreading stuff. But here's the point. These guys are actually working. Like they have a very good platform, just that sometimes technical hitches, as you said. Yeah. So I will take this one Senyor's next question, which was so it was like, Emmanuel, how do you big boys, that's fund managers, trade? And how can we the retail traders survive?
That. So if you in Ghana, right, we SEC doesn't allow you to do Forex trading. So fund managers in Ghana do not trade Forex, like what you see hedge funds and in America and developed markets do, where they have proprietary capital, where they are buying the dollars, the pounds, and everything. So in Ghana, it's that you don't do that. We don't have hedge funds in Ghana. Right. So what fund managers do is we participate in the Forex market by buying dollars or hard currency to buy securities or that are denominated in hard currency. So how do fund managers participate in the Forex market? Indirect, not as if where we are buying the currency pairs like what you do, where you're speculating or right. So I've gotten 10 million Ghana cedis. My 10 million Ghana cedis, I want to buy Eurobond securities. So to buy Eurobond securities, I look at is a CD going down or going up? What do I think is ideal for me to change my money to when do I think is ideal for me to change my money to buy dollar and then go and buy these securities? Now, that's when analysis come in. So I do my analysis and I think, look, from January, February, March, there's always been a trend where the Ghana cedi depreciates against the dollar. There are many factors that causes the Ghana cedi to depreciate against the dollar during this first quarter, right? In January, banks are now multinationals, right, are now closing their books. And when they are closing their books, these multinational will need to repatriate money to their parents group. What I mean is, as a company like Nestle, and Nestle has, remember, Nestle operated from January to December. Now, Nestle has done profits. They will need to give money to their parents group in Switzerland. So to do that, to repatriate money to their parents group, they will surely need to buy dollars. If Nestle is buying dollars off the market, Nestle is not buying $200, $300, $500. Nestle is buying huge volumes. So Nestle is coming to buy over 40 million, $50 million and things. The Bank of Ghana on a weekly basis just gives $20 million on the market. And $20 million, and you are looking at one company, Nestle wants $50 million. Not Nestle alone. There are other multinationals, there are gold people, there are a lot, even banks themselves. Most banks are multinationals. They need to repatriate and everything. So there's a huge demand in the first quarter of the year, right? And also traders will also need money to go and get some goods to restock for the new year, right? Some of them will even request as early as possible because they know in February there's a Chinese holiday. So there's markets there'll be the marketplaces in China are closed. So hence, if anything, they would want to buy the stuff in January as early as possible to make sure the shipping comes as early as possible before the Chinese market close. So you see that in January, we see a lot, some sort of depreciation or pressure on the currency. So knowing that as a fund manager and it's January 1st and I have 10 million lying down in my account, what am I going to do?